You'd think in the world of global accounting, everyone has to play by the exact same rules, right? Well, not quite. Turns out there's a special standard, IFRS 14, that's basically a temporary hall pass for a very specific type of company. So let's figure out why this special permit even exists. And that's the big question, isn't it? It seems to go against the whole idea of international standards. I mean, the entire point is to get everyone on the same page. But there's a really fascinating reason for this exception, and it all comes down to how certain companies get to price their products. So here's our game plan for this explainer. First, we're going to dig into the unique problem that started all this. Then, we'll see how IFRS 14 acts as a bridge. We'll look at the permission it gives, the catch that comes with it, and finally, why this seemingly small rule actually matters a whole lot. All right, so let's set the scene. Our story starts with companies that can't just charge you whatever they feel like. Think about your local electric company or water provider. Their prices are usually decided by somebody else. And that somebody else is a regulator. This whole system is called rate regulation. It's basically a framework where an official body plays referee, trying to keep prices fair for customers while also making sure the company can, stay in business. Now, because this referee is involved, a really weird kind of accounting item gets created. Imagine a massive hurricane hits, and the power company has to spend a fortune on repairs. A regulator might say, whoa, you can't hit customers with that entire bill at once. Spread the cost out over the next 5 years. Boom. That creates a regulatory deferral account balance. It's basically an IOU from the regulator, a promise that the company will get its money back eventually. And this is where the trouble starts. See, the main IFRS rulebook is really strict. It has these very clear black and white definitions for what an asset is or what a liability is. And these special regulatory IOUs, they just don't fit into any of the neat boxes. So if one of these companies were to switch to IFRS, those balances would just vanish from their books. And we're not talking about pocket change here. I mean, look at these real-world examples. We're talking huge costs for storm damage or big investments in green energy. Can you imagine a power company having to write off millions, maybe billions of dollars overnight, all because of an accounting rule change? It would be total chaos. So, to prevent that exact kind of financial chaos, the accounting rule makers stepped in. They came up with IFRS 14, a very specific, temporary solution to this very specific problem. The really important word here is temporary. This is not a new permanent rule. It's much better to think of it as a bridge. It's designed to help these regulated companies get from their old way of doing accounting over to the new IFRS world without everything falling apart on day one. But here's the thing, not just anyone can use this bridge. The guest list is super exclusive. You have to be switching to IFRS for the very first time, you have to be in one of those rate-regulated industries, and you had to have been using these deferral accounts already. It's a very, very small club. So if you manage to get into this exclusive club, what's the prize? Well, you basically get a special permission slip from the accountants. And this is pulled right from the official text. It says you get to continue to apply your old accounting policies. But, and this is the important part, it's only for these specific regulatory balances, nothing else. To put it another way, for everything else the company owns or owes, their buildings, their inventory, their sales, they have to follow the strict IFRS rulebook like everyone else. But for this one weird little area, they get a pass to keep doing things the way they've always done them. So you can really see the split here. On one side, you have the big dream of IFRS, one set of rules for the whole world. And on the other, you have this super practical exception, IFRS 14, that basically says, look, let's prioritize a smooth transition over perfect consistency right this second. Of course, you knew there was going to be a but, didn't you? This permission slip isn't a free-for-all. There is a catch. In exchange for keeping their old accounting methods, companies have to follow some brand new, super strict rules about how they show this information. And this all boils down to one word, transparency. The whole idea is, if you're going to have these non-standard, unusual items on your books, you have to make them stick out like a sore thumb. You're not allowed to just bury them among all the regular stuff. So the standard lays down the law. It says you have to group all of your deferral debits into one line item on your balance sheet, and all the credits into another. And critically, you can't call them current or non-current. They have to be totally quarantined from the rest of your assets and liabilities. This simple example shows you exactly how it works. See that? All the normal assets, following the normal IFRS rules, get added up to a subtotal, and only after that subtotal do you see the special regulatory balance show up. It's completely separate. It's literally impossible to miss it. And this idea of separation doesn't just stop with the balance sheet. It carries over to the income statement too. Any income or expenses from these special accounts have to be shown separately from the company's regular operating profit. It keeps everything neat and tidy. So you might be thinking, okay, that's a lot of hassle for a temporary rule that only affects a few companies. And you're not wrong, but the big picture impact here is actually huge, both for the companies and for investors. For the companies, it's just practical. It makes the huge task of switching to IFRS manageable. But for investors, this is actually fantastic. Instead of accountants trying to cram these weird items into boxes where they don't belong, IFRS 14 forces them out into the open. That means investors can clearly see the financial impact of a regulator's decisions separate from the company's core business. So let's just boil this all down. What are the key takeaways? 1. IFRS 14 is a practical bridge to help specific companies adopt IFRS. 2. The price of admission is radical transparency. You have to clearly separate these unique accounts. And 3. By doing that, it actually helps investors compare these companies more easily. You know, in the end, IFRS 14 is a great reminder that the goal of financial reporting isn't just about making everyone follow the same rules. It's about providing clear, useful information. And sometimes the clearest way forward is a well-lit bridge.